Very warm welcome to all of you here for tonight's discussion of investigating risk reporting practices in the global insurance industry. So with that, I'd now like to hand over to Paul Klumpes, who's going to present the paper for the next 30 to 35 minutes.
Okay, thank you very much, Elliot. Well, thank you everybody for coming. My name is Paul Klumpes. I'm Honorary Fellow of the Actuaries, and I'm very pleased to be here. I've got Ravi Dubey, who is actually in South Africa at the moment, and Abhishek Kumar, who's in Singapore. But we do have Tracy Zalk, who's our research assistant, who I've asked to also be here at the front. So let me just get on to what we're about. This project's really something that over a couple of years, I'll give you some of the background in a minute to the formation, but you've got the paper in front of you, and sorry for those who didn't get it out earlier than we did. In terms of the presentation, I'm just going to quickly go through the highlights. There's lots of detail there for you to enjoy later, but just for tonight, the objectives and framework. A lot of the work that we did was what we call content analysis, looking at annual reports and 10Ks of insurance firms. Also briefly talk a bit about the internal reporting survey, which we did with a group of CROs, and then a few conclusions and recommendations, and I've asked Elliot to keep that in mind also for comments. If you do have any immediate on-the-spot questions, I'm happy to take them through the presentation. Otherwise, we'll try to speed through and give you a chance to comment later. Okay, so in terms of the terms of reference, we started a couple of years ago actually, and we had a lot of people who contributed to this working party. The terms of reference were really looking at risk reporting in the sector of insurance, and we had this delineation of three kind of aspects of reporting, and that came out of a gyro working party, which myself and also Martin White here was also involved with a couple of years ago. This idea that we're distinguishing shareholder perspective, own business perspective, and regulatory perspective. The other kind of aspect of this was, we had lots of people interested in looking at investments, pension funds and things, but we just couldn't do everything. So we decided just to focus on insurance. So we just, again, because of our limited time available, we focused on the largest insurers, and then we kind of looked at a benchmark to the US and Asia Pacific. The focus was on current practices, but we did look at trends as well over time, and we also tried to think about analysing this by focusing on insurance. And there's something very special about insurance that requires it to be analysed in a particular way. So we really went to a lot of hassle to do that. In terms of the background, as I said, we've got the details there. The most important thing to recognise is that there was a lot of uncertainty by the working party as to what were, if you like, the relevant frameworks. And some of the frameworks were about incentives of management to report. Some of it was about corporate governance. Some of it was about accounting. And some of it was just about disclosure. So the working paper discusses all of those frameworks. The other thing that's very interesting is that we did get some funding from the Institute of Faculty, and we're very grateful for Elliot and for all the Sarah Matheson and everybody for helping us out with actually getting funding. And Tracy was there able to help us on getting out some of the more heavy work. And as I said, the current membership you've got there. In terms of the issues, really start with the Walker Report. That was where there's this kind of narrative discussion about risk reporting as an issue, mostly for banking, and there's a little bit of divertissement in the paper about banking, which you can read at your leisure, but banking industry was a lot of the focus of risk reporting. And I think the other kind of aspect was we were worried about insurance being a regulated industry. You've got credit rating agencies, investors. You've then also got regulators who kind of chime in with their own views about risk, on the downside risk. And then in a sense, you've also got the internal issues. So a lot of risks which are, if you like, inherent to the business rather than necessarily like a business risk that's diversifiable away. And that's where the management incentives come in. through the C-suite and the kind of the idiosyncratic style. So we brought that out separately. And we also tried to think about risk management as a process, and we started worrying about a lot of stuff in risk reporting, just ticking boxes, and as an auditor, is it there? Mount Everest, why did I conquer it? Because it's there, as opposed to why, how well was it managed? Was that managed internally or externally, etc.? So that was, that caused us to think about that, and also recognising regulatory world, risk reporting is important, but a lot of these risks are part of, internally generated as part of the conversation you have with a regulator. It's not just an accounting ratio, but you actually go to the hassle of having your own business model, and this is very controversial for banks. So we looked both at external reporting, but we also went inside the business and said, okay, what about risk communications inside the business, things that actuaries worry about, communicating with other people inside the firm. So that was another aspect of our research. In terms of the information flow, you've got 4 different kind of boxes there. We think about the insurance company as a centre, and then we've got managers worried about their reporting, aggregated, maybe a very disaggregated view, not necessarily looking at the past, looking forward, cash flow oriented. You've got regulators who are more worried about value at risk and kind of in terms of regulatory assets. And then you've got the capital providers where it's really more about earnings at risk, I suppose. And we left the box open, which was the one about sustainability reporting, which is an emerging area, but we didn't have time to address that in this paper. And then in terms of different frameworks about risk reporting, one is about incentives. It's kind of like the good story is absent fraud, absent the whale, if you like. Firms disclose more because they want to disclose that. So if you don't disclose in that situation, then you get marked down. So that's like a signalling story. The second story, bad story, is just instrumentalism. So AIG or a government taken over insurer discloses stuff because they have to or they want to be visible. And then there's an ugly story which says there's no correlation, in fact a negative correlation between how much risks are actually borne by the organisation and what's disclosed. So I suppose in a way, you can think about Enron, even Morgan Stanley, to what extent was, misinformation going to the investors, which was false in a way, misleading in a way. And then, so that's one aspect, management incentives for revealing information. There's also the issue about effectiveness, because of course a lot of these documents are very large, so the more the better or not. Corporate governance, different theories about corporate governance. Is it shareholder oriented, US, or is it stakeholder oriented, such as in Germany where you might have multiple boards, or is it, some other story? And then there are different ways of classifying risks, and we note that, there's the COSO framework, which is not really that well specified, but it's inherent risk versus management risk, and then versus other kinds of risk. Lots of institutional settings. I'll skip over that slide, but clearly one of the things in risk reporting, it's multi-dimensional in nature. So you've got, EU directives, you've got accounting rules, you've got government kind of interference, you've got Basel and solvency, kind of pillar 3 things, and then you've got sustainability guidelines and multinational unilateral kind of regulations in a more generic protocol way. So we kind of recognise that, and then the SEC is an example where they have multinational rules for US listed firms. They, you have to report risk in the Form 10K, even if it's outside the annual report. And then the literature, lots of stuff coming out, but not necessarily on insurance. So there's a lot of interesting stories about risk reporting. Basically, why is it interesting? Because it moves. The larger the firm is, the more risks they have, the more they disclose, which is not a particularly exciting kind of finding. But looking at insurance, clearly that Horing and Grundle paper, Geneva Papers on Risk and Insurance, was the paper that focused on risk reporting by European insurers, and we have a few comments about that, as you'll see in the paper. But that was a self-selected construction of an index, and they said, okay, 1 to 100, the more you disclose, the more, on different areas, the more you'll get a higher score. So the score is between 0 and 100, and we look at the annual report and give you a mark for various things. And so, you know, a lot of the questions that we were asking was incremental to that research. You know, we're worried about, you know, evolution in practice. We're worried about, you know, what kind of risks are most likely to be disclosed. Is it the stuff that everybody does, market risks, financial instruments, pensions, or do we actually go beyond that? You know, when we disclose risk, is it saying, yeah, we recognise there is a risk, or is it saying, yes, there is a risk and we manage that risk, or maybe even we didn't manage it, or where was that risk managed? Was it externally transferred? Was it retained? You know, so, you know, we think there's lots of aspects to this which is important for insurance, but the prior research only focused on risk identification, not necessarily how the risk was managed. And then there are other kind of more subtle issues about, how much is that about a quantitative disclosure, how much is actually a narrative and a discussion by management. And certainly in the area of cybersecurity and areas like that, and there's much more attention to, you know, we had a failure and, you know, we had a business continuity plan, or we didn't, or we fixed it up, or we didn't. So these kind of disclosures are not necessarily regulated, but they're kind of voluntary disclosures. So the method, you know, we're just following the prior research. So the first thing we did was we took all the annual reports and we just basically looked at them for year by year. Obviously, we went to the public domain, so we had to go to investor relations. We made the assumption it's only shareholder-based firms. Obviously, a lot of specialist insurers are not necessarily listed or subsidiaries of others, and we didn't look at those. And, you know, we also wanted to look at over time. So we went over, you know, 7 years before the crisis, during the crisis, and after to see how practice evolved. And then we wanted to do some more work, which we couldn't finish, which was actually working out, you know, why did they disclose? And we couldn't do that because we didn't have enough time. What we also did, which was kind of different from prior research, most prior research only focused on the first one, which is shareholder disclosures. So, you know, the weighting and the identification of risks is for the purpose of shareholder reporting. But we recognise that there are other users and other capital providers and other constituents who use the annual reporting process to assess risk. Regulators worried about downside risk, and then also, if you like, there's also more of a private conversation between a manager and the shareholders and others about, you know, what kind of risks were sustained by the manager, to what extent were risks idiosyncratic as a result of strategy, as opposed to a risk that had to be disclosed to meet an accounting requirement. So that leads us to a third conversation. So we had 3 sets of indices. We started with the Horing and Grundle, and, you know, you've got the details in the paper, and then we repeated that for every year, and then we kind of subtotaled that, and then we did it again, but we reclassified the risks using the Patrick Kelleher et al. Approach, and I'll mention that in a minute. And then we kind of then toggled it again and say, okay, well, maybe, you know, instead of worrying so much about market risks and weighting everything on whether they disclose financial risks or not, maybe some of these softer risks are also important. So we kind of then re-toggled it to give those softer risks a bit of a bigger weighting. So the difference between the two disclosure indices, we've got the Horing and Grundle approach, which is very much identifying risk as classified by the, you know, the CRO forum, the Basel Committee, which starts off with, say, market risks, equity risks, and then, you know, you've got credit risks and then liquidity risks, so all these kind of silos, and then we add on operational risk. Kelleher et al. Were kind of slightly more comprehensive, and they were thinking about actuaries in an insurance setting, so they added to that a few more kinds of risks, like strategy risks and, you know, frictional risks and aggregation risks. So it was a slightly more comprehensive view. And also when Kelleher were doing that work, they had different levels of risks, so there was more a description of what kind of risk there was. So market risk, for example, under Horing and Grundle, you know, is there a definition? You know, is there precision about it in terms of limits and risk mitigation, value at risk? Kelleher et al. Had a different way of thinking about market risk. They said, okay, what kind of risk is it? Is it equity risk, bond risk, property risk? What kind of market risk is it? And then, below that, you might have 2 or 3 levels of more detail. Okay, and then, as I said, the sample was based on the top 25 global insurers. And of course, limited resources, so we ended up only with about 13 of them, and the reason is survivability. So, some of the bigger insurers who might have assets under management, but not necessarily premium growth, were not included, or they weren't as big in 2006 as they were in 2012. We ended up with 8 European, free agent, and 2 US firms. And as I said, we got the detail about how we, went into the detail of that, and obviously a slightly different perspective, slightly different frame of reference for understanding risks. So the things that mattered were slightly different. So obviously more comprehensive for shareholders. For regulators, it's slightly more about to do with downside risks. And then for CRO, you're kind of picking up other things like narratives, performance measures, management incentive systems. These are also kinds of risks, but not necessarily thought of as a generic kind of risk. We've got a few kind of slides and things. You've got the detail in the paper, so I won't go through all the detail, but just, obviously we like to kind of give a score. As accountants, we always want to keep score. So, the Europeans obviously scored highest on regulatory disclosure. On the other hand, the US firms were more higher on the shareholder side. Asia Pacific in general was slightly lower than the other 2. But remember, we've only got 3 firms, and 2 were Japanese and 1 was a Chinese firm. So, we don't really have a lot to compare with that. In terms of European, the other thing we did was we only focused on the top firms, so we could actually do a firm-by-firm comparison. And if you exclude ING, because ING is a little bit special, because it's really bancassurer, so you don't know whether it's the bank aspect or the insurer aspect. So if you exclude ING, you'll find that it's a kind of almost a dead weight score between Allianz and AXA in terms of the scores, and also Munich Re. Munich Re, being a reinsurer, has also quite a comprehensive view of risk. We did look at Swiss Re, but we weren't sure whether to include it in the final list. In terms of the CEO view, slightly different kind of take. Again, Allianz and AXA are up there, Zurich as well. On the other hand, Generali tend to kind of obfuscate a bit more, maybe not necessarily go into the detail that the other firms do. And then regional summary, obviously again, the US and EU and Asia Pacific. Here what we've done is we've just toggled it to say, is it the standard Horing and Grundle approach, or is it the Kelleher et al. Approach, where it's kind of slightly more comprehensive, or is it the re-weighted approach, where it's a bit more weighting to the soft risks? And as you slightly re-toggle that, you'll find that the story changes, so that, for example, the Asia Pacific firms tend to disclose more about softer risks, as the US do, compared to, say, European firms. Whereas, European firms under the traditional Horing and Grundle approach on about precision tend to outperform the other 2 regions. And then, a bit more detail on a blow-by-blow basis. I won't go into the detail there, but again, it tends to be ING tends to score the highest, but then again, it's because it's a bancassurer kind of moving out. AXA also scoring highest, but then, it does toggle across the different ways of defining, how you classify risks and what's important or not. Interestingly, again, Generali doesn't do that well. In terms of the British ones, obviously Aviva and Pru are kind of up there with the others, and of course they've got a little bit more to kind of play for. They've got both, the sophistication of having to deal with FSA, what was the FSA requirements, and as well as, having a communication to shareholders about the other things. So there's a bit more of a detailed conversation going on than you'd have for the other firms. So that was the kind of disclosure, content analysis kind of aspect of our research. The second aspect was the internal reporting kind of element, and that's where we did a short survey. We actually were very fortunate that out of the 12 or 13, 14 firms we sampled, 10 of what we regarded as the main user of internally generated reports, being either the CRO or the nominated person who then uses those internal reports to make decisions. We got 10 out of the 14 responded, and we used the Brighton conference, and we had the CRO forum that helped us a lot there. And again, we're really grateful to the profession for helping us out, getting such a great response rate on a survey monkey. And we covered the 4 areas really, corporate governance fit for purpose questions. We've got the questions at the back of the document there. The link to the risk appetite, the use of risk reporting, and the reporting capabilities, the breadth of it. And what we were trying to work out here, we're just trying to get a feel for, okay, we're not necessarily having a conversation with outsiders. We're talking about a user inside the organisation who wants to, work out, I get lots of this stuff coming through my office every day. How much is actually useful to me to inform the board or to help me make decisions about managing the business? So again, good response rate. We had, this idea that in terms of the results, we had to be a bit careful here because we promised anonymity, and we allowed, a full conversation to happen, and we kind of assured the respondents that we wouldn't, kind of out them in any way at this event or anything else. So we had to be very careful in discussing the results, and you'll see the discussion in the paper. But basically what we found was that, again, there were some kind of areas of concern by respondents about the usability, that lots of stuff going on that they'd like to know about, which wasn't in the report, or there's lots of gumph coming through that's not necessarily helping them. So there was a little bit of kind of concern about, critiquing a little bit, the quality of the material that was coming through, both in terms of fit for purpose, but also things like capability. How was it grounded enough to help you make a decision? Was it too grounded? So we have a little bit of detail there that you can read in the paper. In terms of the conclusion, as I said, I don't want to kind of drag out the discussion. I realise my time is not that much left over. So in terms of the overall conclusion from our research, what we found is, risk reporting is an emerging area. It's kind of the topic of risk communication. And I'm sure, a lot of actuaries, very good at what they're doing, but it's very important for them to kind of communicate that effectively to other people inside their organisation, to stakeholders. So it's an area where there seems to be scope for more work. We do try to have a look at this from a perspective of actuarial profession, looking at insurance, and we know that that environment is different from unregulated environment. It's different from the banks, where there is a lot more pillar-free stuff. There's a lot more things happening that's not necessarily coming through on the Solvency II yet, and obviously Catherine will want to comment on that. But also, we do try to think about the topic. We don't necessarily go a lot deeper. We're very much at the tip of the iceberg here, so we're not pretending this paper is academically a deep paper. What we are trying to tease out is, first of all, the sensitivity of our self-constructed index across different definitions, and you can see there's some variation there. But also, we were very concerned about actuaries day to day in the business, talking to other risk professionals in managing global organisations, and how useful is that information to them at the disaggregated level, not just at the consolidated, aggregated level that goes to auditor and gets cross-checked by shareholder or credit rating agency. And clearly, one of the things we have there is that there were some concerns about the quality information. And we found that the actuaries are the ones, they were very much involved in preparing the information, not necessarily the ones who are, the decision makers. So we know that the Basel Committee, for example, has just come out with recommendations for the quality of the information that's produced and communicated. And so that's, we have a couple of challenges for the audience here from your practice as to whether you think this is something for us to think about as well as a profession. So my kind of recommendations for the research, obviously, we would like to extend it in a couple of ways. One is think about what drives the risk reporting process. Is it connected to size? Is it connected to profitability or risk reward ratio? are the firms which are more, sophisticated in terms of their ERM, conversation with credit rating agencies, also the ones that report more on risk reporting, or is it just really a bad story or an ugly story where risk reporting doesn't seem to connect in any way to the sophistication of the firm? And then also, we would like to get a bit more guidance. This is very much work in progress because a lot of the really latest kind of stuff coming out from ASB and FASB on things like, what are risk reporting requirements within accounting standards is still quite vague in our opinion and needs more fleshing out. And also, under Solvency II, we're aware that there's a Pillar 3 requirement, but there doesn't seem to be much of a conversation going on as yet between the industry and stakeholders about that, because perhaps it's not that well developed, or perhaps there are things they're worried about. Question is, does the profession, the actual profession, want to actually, given that actuaries are so important in both being careful about risks and perhaps challenging others inside organisation about their perspective on risk as being simply value at risk or something, that perhaps the actual profession itself could actually take leadership here and think about maybe developing some recommendations on that. So as I said, I think I've got some challenges for you, and I think I'll leave these up on the slide for people if they want to comment on it. I have asked Elliot to consider that in terms of the kind of feedback you want to give to this session. We look forward to your comments. As I said, the 4 questions are: should the actual profession actually, go to the trouble of providing more guidance about risk reporting, either in a specific context? It could be pension reporting, or it could be, in guidance in applying, for example, insurance contract reports in terms of where the actuaries get involved, or more generally about narrative that goes to stakeholders. Second, how much do you think actual profession should kind of go down the line of existing risk management professionals, where the things that get measured are the ones that we worry about, things that happen all the time or regular, like market risks tend to get reported regularly, things like, does the firm have a captive insurance arm, are there strategic risks related to managing an environmental or CAT type risk, is there a conversation about that in the annual report of a general or a reinsurer or not? These softer risks, and that's the second question. Third question, to what extent should there be a position by actual profession on risk effectiveness? In other words, meaning, there's a trade-off between saying, I disclose more and more information, it costs me money to do that, and on the user side, you can disclose more and more, but then I'll just end up getting confused and I won't know, which Q is the relevant one for me. Is that an area where actual profession would want to have a statement about? And then finally, is there a kind of a conversation about risk communication in general? Is that a topic that actual profession would like to have some kind of guidance on, or some kind of discussion about? Certainly, I was in a conference in Oxford a couple of weeks ago, and some of the insurers and some of the specialists were saying, yes, we're very concerned about risk communication, but they were talking about the different graphical representations of environmental risk or hazard risk, and they were worried about translating those metrics into something that a shareholder could understand. Okay, how much of your earnings is at risk if you don't worry about this CAT risk or you don't manage it properly? So those kind of conversations are very important, and actuaries surely have a role to play. So with that, I think I thank you very much again, everybody, for coming and for having the chance to present this paper.
Many thanks to all of his fellow authors for such an interesting paper. I thought that it was not revelatory, but certainly brought home some things that I hadn't really thought about before, especially the lack of standard frameworks. And this, of course, is something that when people are reporting publicly, to not do so within a standard framework makes it much more difficult for the readers to compare one with another. And that's clearly something that they found when writing the paper, in that they developed these 3 different rating systems that, although gave somewhat consistent results, weren't 100% consistent by any means. So this brings us to an important point, which is what's the point of risk reporting? What constitutes better risk reporting? It's clearly not just more. More of anything is rarely a good thing, and especially more reporting can be a very bad thing if it obscures the material points with lots of irrelevancies. It's not clear to me, for example, that the going into more detail and defining what you mean by each type of risk is actually helpful to all readers. There are many different stakeholders. Do different types of reporting suit different stakeholders? And that's certainly something that, if regulation is called for, something that the regulators would have to bear in mind. Another sort of challenge I'd have to all this is risk reporting really more important for insurers than for other corporates? I mean, I know why we're discussing it. It's because we're actuaries and we're interested in insurers. Of course we are. But you could say, and this is possibly slightly unconventional, that maybe it's less important for insurers because they're more aware of risk and have it more under control. The big risk in their business, you might think, would be insurance risk, and that they should be on top of that. Whereas other corporates who aren't thinking so explicitly in risk terms may actually be not controlling it so well. Just a thought for you all. What should the profession be doing, if anything? Well, risk is at the heart of what we do, so thinking more about risk reporting is probably a good thing. Thinking about maybe how different forms of risk reporting might affect different stakeholders, what would constitute better risk reporting for the different stakeholders, and thinking about, especially I think, how actuaries can better communicate about risk internally. Actuaries aren't responsible for public reporting of risk. They're very responsible for a lot of the reporting that goes on internally. It's something that we should be good at. I don't think that we necessarily always are. Thank you.
I would take issue with some of the points that Paul and his team made. I don't think the statements in accounting standards are bland. Actually quite powerful principles in terms of disclosure of risk. And I think I'm slightly concerned that, the trouble with, I think, emphasises Louise's point, the trouble with specific guidance is that businesses are very different and their users might have different views. And I think a principle-based regulatory system is actually much more powerful. I appreciate it leaves things open to the practitioner and the preparer, but then you have market discipline and that should influence those things. It actually is quite interesting that within insurance, a subject close to my heart at the moment is accounting for insurance. And we're holding a seminar in a couple of weeks' time. We find it very hard to find investors to come and, users of insurance accounts to come and talk to us about that, because actually the disclosures are probably not very good. So we do have something to learn, but I think the actual principles in the standards, and actually I'd also, a little sort of puff for Louise and the Board for Actuarial Standards. There is a requirement in TASR about reporting risk, which is actually quite a powerful principle. I'll refer you to paragraph 5.5. And I think, if actuaries read that and interpreted that, and that would give them give their users of that information a lot of comfort in what they were reading. Thank you.
Thank you very much indeed. So Paul, we had a couple of questions there. Did you want to respond yet, or should we go for more questions?
I could just respond to just very quickly to that, because let me first thanks Louise also for her comment as well on the question about what's the point of risk reporting. And you mentioned the question, is it more important for insurers to disclose risks than those who don't? And it's a very good point, because I've done a lot of work looking at non-financial multinationals where it's about, unless you're an Enron, it's about mitigating a source of risk which is not necessarily correlated with your business purpose, your strategy. You've got a lot of financial risks you've got to manage and disclose that, whereas insurers, that's the heart of the business. What we were struggling with, though, Louise, was what kind of risks are we talking about here? And obviously insurance risks and underwriting risks are the core of the business. But on the other hand, insurers do have lots of other stuff going on as well. Some of it's emerging risks, some of it is financial risks. And given that, the value add of an insurance firm is being able to transform capital from one to another, and that's kind of their major function in the economy, actually really taking on risks and transforming that. I think it is important that, that there's a comprehensive discussion about that. But I certainly take that point on board. Thank you, Louise. Sorry, the question about financial reporting. Council, I guess, let me just answer that two ways. I agree with the point about principles versus rules-based, but there are some very important risks where it seems to be almost kind of cut and paste, and that's been particular financial instruments where, there's not much difference between SFAS 133 and, the IFRS, to be honest, and it is very, very specific. I suppose what we were worried about in our research was, and I talked to Catherine earlier as well, was that, okay, there's one question about what the gap is or what the accounting rules say. It's a separate question to ask, how is that gap applied? And one issue is how much room is there to apply the gap? And I suppose separately also, how much is disclosed voluntarily? So as opposed to just ticking a box saying, yeah, a lot of the things we see is because it has to be disclosed. What we were interested in, and that's why we went to the CRO view, how much was actually voluntarily revealed about, for example, the performance metric that the firm uses and tells its stakeholders. Like Aviva seems to use ROCE, whereas other firms use ROE, or is it an adjusted, And I think that's an important conversation. It's also a discussion about risk too, but it's a different kind of risk conversation than talking about financial risks on a hedged or unhedged product. So I do appreciate the comments, however, and I think that's something we need to be a little bit careful about, that we delineate this idea that, yeah, if it's a principle-based approach, yes, of course, there's more scope for variation, and that's great for the market too, because the market can then make its own judgment rather than having to be in a straitjacket situation.
Thanks very much, Paul. Is there any other questions or comments from the floor at all? Yes, David. David up in front here.
Yes, my name is David Martin. I was interested to read in the introduction to the paper a statement that it is surprising that the topic of risk reporting has received relatively little attention from the actuarial profession to date. It's not a subject that I have a great deal of knowledge about, but what I do know is there's been a great concentration in the profession in the last 2 years on enterprise risk management. And it occurred to me that maybe all the training that we're now giving in CIRA and so on should include risk reporting as well as other elements of risk. And I would be interested in Paul's comments on whether the syllabus on risk should take this topic into account more than it currently does. Thank you.
I mean, obviously there is the new qualification, the Chartered Enterprise Risk Actuary, that's also quite an important element there. I suppose it comes down, from my perspective, as to whether you see ERM training as being kind of, if you like, comprehensive in sophistication, or whether you are seeing it as a process. If you're seeing it as a process where it's kind of you're allowing a bit of risk culture to come in, influencing how the extent to which firms engage in that process, then clearly risk reporting is a key element. But it's an element that's not, necessarily receiving the attention of actuaries, because the actuaries are very much worried about things like financial model risk and they are worried about, conduct risk You know, that these are very important things for actuaries. The actual communication of that in its various forms is, you know, after you identify it, after you measure it, after you assess it, yeah, you have to report it. You know, it's a critical element, but you have to, you would have to agree that ERM is really a process rather than just a product or just an instrumental kind of brand name that you would use to promote the company to both credit rating agencies and others. So I think it's an area where I think yeah, it's an area where I personally believe that if you wanted to get a good message across to credit rating agencies and have a conversation with stakeholders, then it is worth your while going to the hassle of thinking about the quality of these processes as also involving the quality of the risk reporting that underlies it. But that's just, again, very much more of a personal view, and I'd like to get maybe Catherine, you might to think about that as well from your role given later.
Okay, that will come later. Okay, thanks very much, Paul. Are there any other questions or comments? Yeah. Good. Please.
Hi, it's Chris O'Brien. Delighted to have the paper on risk reporting. We've learned a lot more about risk in recent years, but part of that is, as the authors say, how do we report that risks and what can we learn from the practices that have been in place to date. When firms voluntarily disclose risk on in their accounts, while that may be helpful to investors and other stakeholders, it may of course also be helpful to their competitors. Therefore, regulations can have an important part to play in encouraging greater risk disclosure. And the authors mentioned regulations, and I'd like to say a little more about two of those in particular. I think that these disclosures then lead to some useful insights about firms, their risks, and how they manage them. First is the Companies Act 2006, which requires firms, and not only insurers, to describe the principal risks and uncertainties facing them. And typically, firms go on to describe how those risks are managed. It's therefore common to see listed firms' reports and accounts having a specific section about risks before we get to the profit and loss account and balance sheet. This can, I believe, produce some interesting insights into firms. For example, looking at one UK listed insurer and its 2012 accounts, it talks about group risk appetite, risk governance structure, and the risks disclosed include, for example, claims management and reserving, reinsurance counterparty risk management, and regulatory and emerging risks. One risk was noticeable for its absence. A few years ago, there was a survey of small and medium-sized enterprises, and the risk that scored most highly when firms were asked to say what are the most important risks affecting you was the risk that the demand for my product or services will decline. This insurer made no reference whatsoever to this demand risk, and I hasten to add it was not a closed fund firm. And there's a danger that risk management concentrates on supply risk because it's easier to manage. If a firm buys raw materials from abroad, it can hedge the foreign currency risk. If it's a building firm, it can tell the workers to wear hard hats. If it's an insurer, it can price its products taking into account the probabilities of claims. In contrast, it's much harder to tell your customers to buy your products. And so a more rounded risk discussion would include both demand and supply risks. Incidentally, I would also suggest that the comment on page 9 of the paper that prior to the financial crisis, there was almost no requirement for insurers to provide a narrative on their insurance business or emerging risks does not really appear quite right. The Companies Act requirement is derived from EU legislation and hence applies to a number of the insurers covered in the global survey and may have contributed to the relatively strong showing of European firms. However, the authors are also aware that differences in firms' risk reporting disclosures may reflect other factors such as size. And indeed, if you look at the 3 Asian firms in the survey, they are all smaller than average, and that may have been a factor contributing to their relatively low index scores. I appreciate that the authors had a limited sample on which to try and refine their analysis. Turning to the second set of regulations I wanted to mention, we have the International Financial Reporting Standards. Whilst the authors refer to the requirements for risk disclosure put forward in the exposure draft recently issued by the IASB, their existing IFRS 4 already sets some standards in this area. Insurers are required to disclose information that enables users of their financial statements to evaluate the nature and extent of risks arising from insurance contracts. It's interesting that while banks usually disclose value at risk as part of their risk reporting, very few insurers do so. Of course, as the authors say, the credibility of value at risk has declined following the global financial crisis. One firm that did disclose value at risk was AIG. On page 23, the authors say that AIG provides the highest quality disclosure under the regulatory perspective. I think that would come as a surprise to members of the Extreme Events Working Party, who in a recent paper illustrated the disconnect between the VAR that AIG disclosed and reality. What I do find very helpful as part of the risk disclosures is the sensitivities that firms reveal. For example, does a change in mortality affect annuities more than assurances? And some general insurers show how their results will be affected by certain stresses, for example, the Lloyd's disaster scenarios. In conclusion, I think there are plenty of examples of risk reporting practice, some good, some less so. It's a recent area, and I think there is time for firms and actuaries advising firms to look at those examples and say, yeah, this works. This would be a better way forward than maybe we have done to date, and would help both the investment and wider community understand the risks and what firms are doing to manage them.
Thank you very much, Chris.
Well, let me respond to one point that Chris made, was in connection with the requirement under the Companies Act for again, it's an illustrating point about principle versus rules-based. I suppose my own perspective is that in the US there's very much what we call a registration process involved in company filing. So there is the SEC requirement to all US companies under the Regulation 32, which came out after financial crisis, whereby all the US firms in their 10K must provide narrative about their risk, the risks they engage, and furthermore, they even have to show 5-year ahead cash flow commitments and obligations of things like operating leases and all the off-balance sheet stuff. And of course, that's very closely monitored as part of the filing system. And so again, it's an example where there's a lot of precision in the regulation. There's more disclosure, there's more detail there. On the other hand, if you do have a principle-based approach, which is very important in the European context, there's a question of interpretation, and whether the interpretation of that regulation by the firm, and then also with the auditor signing off as well, and to what extent you would expect more variation across the firms in practice under that regime than if they were subject to this kind of straitjacket 10K. So some of the things that we're finding could well be related to size, as you've pointed out. It could be related to the culture, and the culture in the US is very much more, kind of the Keystone Cop stuff, whereas in the European context it's much more a negotiation. So you'd expect more variation. But I do thank you very much for your also other comments, and we'll certainly want to take that on board as well.
At the moment, just to talk to your, maybe pick up on question 2 there, which we haven't had any asked on the floor yet, the need to balance a desire for quantification of those sort of, I guess what we call quantifiable risks and the less measurable soft stuff. I mean, did you have bit more that you wanted to sort of say on that at all?
Well, I do. It's a source of huge frustration for me as a researcher that one of the issues we looked at, especially in the non-financial context, and I did have conversations with the SEC on this, was that we noticed there were a lot of multinationals which have got captive insurers. So, you know, Coca-Cola, you know, the really large S&P firms will, under their contractual commitments and obligations, reveal the fact that they will have a captive because they have to list their subsidiaries. But then when we go down the detail, yes, we can identify there is an address somewhere in, you know, in an exotic island in the Caribbean where Coca-Cola has its captive. But we don't know how much of the risks that, you know, Coca-Cola has, or the pharma firms have, or even the financial firms have, which are, you know, which are retained within inside the organisation and are not, you know, engaging with an insurer externally in order to manage or cover that risk. And I suppose that will come back to the question that was very interesting that was raised by Chris about information that's about the supply of risk and the demand for risk. I suppose turning that around, it would be, you know, I think it would help the operation of markets if firms did come more clean about how much of their risks in related to specific, you know, strategy risks or you know, office liability risks or specific kinds of risks are managed, you know, by their captives, yeah, and how much is that exposure relative to the risks that are transferred through contract with insurance firms, and turning it around, you know, again for the insurer, how much of those risks are, you know, of the total sales and of the total, you know, action that they are engaging with, how, you know, what's the quantification of how much is managed inside and how much is actually transferred outside. And this is kind of soft stuff. It's like the conversation you would have about post-crisis. Yeah, there were a lot of cross guarantees between different parts of entity which were managing risks, and we know that in Parmalat and famous or infamous cases, those risks were huge. But what about for the insurers? You know, how much are there cross guarantees, and how much of the risks are managed through their governance structure? And we know through, you know, another example most recently with Morgan Stanley that, you know, a lot of the problems with the whale were because there was a bit of unclarity about the status of its subsidiary in London and its regulatory status. And that obfuscation may have contributed to the incentive problems facing that organisation. So I think having a proper conversation, again, it could be about enterprise risk management as well, you know, just having a more mature conversation where it's not just, you know, going to a level of precision about value at risk, but actually having a more wholesome conversation. It's going to help also the regulator, and it's going to help outsiders. But that requires more narrative, it requires more coming clean about things. And I realise I'm coming from the blue corner, I'm from the public interest perspective, and there could well be reasons, you know, not wanting to disclose too much to competitors. I understand that, you know, management doesn't want to necessarily reveal too much to their competitors. But, you know, I think it's an area where, you know, if we are going to advance risk reporting, we don't want to just say what is the risk, how is it measured, but actually how effectively is it managed, and how much of that risk is managed internally, how much is then transferred outside.
Yes, Louise Pryor again. I think that last point you made about the competitive advantage is really important. If you take what some people might consider a hardline view that managing is essentially risk management, that what all companies are in operation to do is to take advantage of some risks, the ones that they think they can handle better than other people, and that can be seen as applying to manufacturing companies and services companies as much as insurers. The last thing they want to do is to explain to all and sundry exactly how they're managing those risks, because that's their competitive advantage in a nutshell. So it's you can see why they wouldn't want to do that. Now, I suspect that in many cases that's not their conscious reason. It's their conscious reason is that actually they haven't thought through it in much detail and they don't actually necessarily know what's going on. But it's clear that there needs to be some sort of middle ground. That actually, if we look at investor stakeholders, for example, they do want to have some idea of what the managers of the company think they're doing with the company and what the competitive advantage is. So you probably want some overall picture of what the risks are and how you're managing them and why you think you're good at that particular risk. But going into too much detail is really going to make it then difficult for you to compete in the marketplace.
Mm-hmm. Thank you very much, Louise. Okay, Paul, did you want to respond to Louise at all? Or is that...
Yeah, I think I agree, Louise. I think I think it is important to recognise that we don't just all want to be regulating everybody to death here. There has to be a little bit of freedom and scope, and I think we have to recognise the role of the market, and even the investment market, hedge funds and other active investors will want to have a little bit of a play and be able to go long and go short on these strategies. What I may respond on one point, though, is that I have noticed in certain regulatory environments that regulators require more detail. So, for example, in Switzerland, the national regulator will, for example, put on its website all the general insurers, and some of them are actually captives of the large Swiss multinationals. And again, I think also in the Swiss context, it's interesting that the Swiss regulator is the one who was at the forefront of things like the leverage ratio in the banking area, where as a systemic risk to the Swiss government, I suppose, they are worried about just the scale and size of UBS and Credit Suisse, and therefore they are risk-taking, and they will go to the hassle of actually allowing some transparency about just that. Having said that, I think culture is very important too, in the sense that in certain cultural environments, it seems to be more a relaxed conversation that you can talk about things like, for example, just model risk, and actually firms are prepared to have a discussion about that there is model risk. And we've noticed that outside, in the UK environment, in these environments where it's principle-based, there seems to be more of a willingness of companies to have a narrative about model risk, whereas in other environments, it seems to be less something that's not talked about, or it seems to be an assumption that it's all under control. So I think we have to recognise that. We have to recognise also the cultural differences in regulatory environment, as well as that of the companies themselves.
Thank you, Paul. Any other questions or comments from the floor? Yes, in the middle. Just wait for Petrina to get to you. Thanks.
My name is Peter Telford. Can I pick up on two things just said a moment ago? Firstly, from Louise Pryor, a really good point that competitive advantage relates to the risk profile of a firm, and the very source of a firm's competitive advantage may also add to something to its risk register. It's very important that risk reporting doesn't sit in a silo and be divorced from the rest of the firm's reporting, because if you read, let's say, 20 pages of brilliant strategic story and then 3 pages of doom and gloom risk afterwards, you will end up with perhaps an unbalanced picture of the firm's prospects, and that you can't split those two. They're inherently joined. Second really good comment that Paul made in passing, that regulation of disclosure drives culture as well as directly driving what is disclosed. I've seen that, not in my present firm, where a risk management framework that was evolved in and driven by one regulatory environment completely failed to port across to a different regulatory environment. Part of the reason, I think, was that the culture wasn't ready to receive and operate what it was being handed over from the other side of an ocean. So for that reason, I go back to the first question that's still on the screen. I'm very nervous about the word specific in the question, should we have more specific guidance? Even within one national or regional reporting culture, every firm has a different chosen risk profile and therefore a different appropriate emphasis to make in its risk reporting. So I'm all for principles, but very nervous about specific rules.
Let me just comment on one thing about culture. I think certainly the Swiss example was very interesting as well, because in the Swiss solvency test there doesn't seem to be a lot of regulation about things like model risk, and we know that the regulator will compel even boutique insurers in Zurich to adopt a minimum template. But that also then leads to the question about the framing of risk, and I suppose if you do go down the route of more precision, then it also then frames what that regulator considers to be the relevant template. So, for example, I asked the Swiss regulator, I said, well, that's very interesting, why is it under the Swiss solvency test there isn't a specific requirement for disclosure, monitoring of model risk? And he kind of turned around and said to me, well, but we're Swiss, we make watches, and how dare you, it's kind of really angry, and so in that environment there didn't seem to be a scope to, having a discussion about that, and I think that's very important, to recognise that, the culture is, you can't just cookie cut one set of guidelines to a different environment, because it is different interpretation, legal enforcement, and even regulatory culture will differ.
It's David Martin again. My question is in connection with particularly the point made about the soft risks. There was a very good paper a little while ago given to the Institute faculty about classification of risks. And there was discussion then about the difficulty of what you're describing, and two different organizations or two different people might describe the same thing in different ways. And the lack of having a classification perhaps leads to a lack of communication, because if you haven't got the terms right, communication can be rather difficult. So it seems to me that one of the advantages, one of the things that the profession could do, would be to put more emphasis on classification, so that particularly in areas that are in the soft risks, people are slightly clearer as what it is they're reporting, and that might well enhance the reporting of risks.
Thanks very much, David. Did you want to respond to that at all?
I just will mention that Patrick Kelleher was
he was the author
the
of
risk
that paper,
classification party, of which I was a member, and he's been obviously moaning about, I think, the fact that the profession hasn't been so upfront in supporting the work that he was leading on efforts to provide a comprehensive risk classification system. There is some discussion about that in the paper. What I would like to mention, though, and that's something very interesting I found in doing the research, was that one of the criticisms of that is that you then end up siloing different types of risks in different silos. And I thought one of the things that came out of the financial crisis was that companies like RBS got into trouble because they had whole portfolios of risks that went right across these different silos and that weren't effectively captured because they didn't fit within the silo. And that was one of the self-criticisms of RBS's director in reporting to the Scottish Parliament. So I think we have to be careful that, it's important to have a comprehensive view of risk classification, but also recognise a lot of risks go across these risks silos, and we need to be thinking about it in a more dynamic way than just kind of cookie cutting, credit risk, whatever that might come through this paper.
Just to follow up on David's point there, I mean, we as actuaries, obviously Patrick did that very good paper on risk classification. To what extent do you think we can, as actuaries, sort of influence sort of the way in which people use these categorisations without engaging with organisations like ISO, for example?
Well, I think one of the things that Patrick was doing was he was actually having conversations with the ABI, its OREC system. He has been talking to Premier and other organisations who are very interested in this idea of a comprehensive view of risk classification from an actuarial perspective. And I think just the sheer richness of the work that the party did, where they had the high-level risks, and then they broke it down into 2 or 3 levels, and there were Excel templates that were available for people to read. I think that was in itself a very interesting exercise. And I think, my final comment would be, have to be careful here though, because a lot of risks are what we might regard as emerging risks. And these risks are very important to certain kinds of insurers, like reinsurers and general insurers, in a different sense than they would be to a life insurer. And I think, I suppose my only concern with whatever risk classification system we decide to use is that we have to understand that the frame of reference, is it just about the business risk, the strategy risk that the firm manages, that it reports to, or is there also a conversation about the risks that are emerging and worry its underwriters in terms of pricing moving forward? And I think that's an area which is still a bit unclear to me.
Okay, thank you, Paul. It was just picking up on the, actually it's the path dependence of risk disclosure. I don't know if you had any comments on that. And what I mean by that is that once you've put some risk information into the public domain, people might think it's actually quite difficult to then take that away. So you can't actually, it's very difficult to change your mind once you put that into the public domain. Do you think that, do you have any thoughts on to what extent that is an impediment to people putting more risk reporting information into the public domain?
I think there could be an impediment in the sense that there are 2 answers to your question. One is that revealing voluntarily a whole set of risks that are out there, for example, just even the fair value reporting when it first came out by some US banks, they found that when they did a lot of fair value reporting, the market actually responded negatively because it got confused. So I suppose one difficulty is whether the market or the market participants sufficiently comprehend the disclosure to be able to then make a decision about it. The other kind of aspect of path dependence is this kind of conversation that an investment manager would have with a client, where they say, okay, I understand all the different ways I can value a bond and all the different kind of points and all the different elements of my bond portfolio management. Do you understand it? And did you therefore comprehend what I'm doing? And so I suppose it's almost a question of education. It's a question of educating both the public and perhaps more specifically the investment community about what these risks are and how well they're being managed. And I think that's one reason why having some form of neutral guidance on such topics, it has the public interest benefit of it being in the domain in a way that's neutral from an independent body, rather than an individual organisation which happens to have a lot of these risks and then attempts to reveal more, or perhaps doesn't, gets into trouble with its own investors, as opposed to other firms which don't choose to do that. So I think, I think there is a certain level which experts, professional experts, actuaries, can have a role here in education.
Catherine, I'll invite you to close the debate. Sorry.
Thank you, Paul, and the team for a really interesting paper and presentation. And thank you to everyone for your contributions. When I'm reading a novel, I tend to prefer those that introduce the characters and then put them in a stressed situation, often with an apparently depressing outcome. My favourite books, however, retrieve the characters with a serendipitous twist. The goodies get married and live happily ever after, and the baddies get their comeuppance. This paper reminded me of my favourite novels. We started with an introduction to the characters, the insurance companies, the shareholders, the actuaries, the accountants, the auditors, the regulators, and I'm not going to comment on who are the goodies and who are the baddies. We had a stress situation, the financial crisis, and an apparently dire outcome, good risk reporting being almost impossible because of a lack of consistent standards. But the happy ending is hopefully not an ending, more some green shoots of good practice that lead me to think that Tomorrow is another day, in the words of Scarlett O'Hara. But we have to get to the another day if we want to live happily ever after. And I think the indices in the paper give us a measure of whether we're heading in the right direction. It's hard to measure the quality of risk reporting, and the paper sets out some approaches. Reporting generally is fraught with difficulty. We have to be transparent and be clear, but if we make it too simple, then it loses its meaning. And as Louise pointed out, if we have too much reporting, it won't be helpful. People won't be able to see the wood for the trees. Thinking about the 4 issues for consideration, first of all, the authors called on the profession to give more guidance on risk reporting. Now, I tend to agree with this, and it fits with our President's call in his address for us to ramp up our relevance. Paul made it quite clear that we should think about the incentives for reporting and the incentives for transparency, because these are quite varied. And this leads me to think that guidance would be useful, as it would take away the impact of those incentives. He also mentioned that guidance from a profession would be neutral. It made me think that as more actuaries become chief risk officers, does that mean that we as a profession should be giving out more guidance? Something to think about. Louise pointed out that standard frameworks would help the reader and would improve standards, so this would improve the clarity of reporting. And John Instance and Peter Telford both said that principles might be better because regulation can drive culture, and that might not necessarily be in a good way, and it might not be scalable. And perhaps starting with the TAS on reporting might be a good place to start. So more to think about there. The second challenge was identifying how to make risk reporting meaningful by including less quantifiable risks, which might actually be more important. This is something that I think is important. It's something I've been worried about, actuaries learning more and more about less and less until we know everything about nothing. So this seems to me a fruitful area for research. Paul highlighted in his presentation that there are different approaches in different regions of the world, and we can learn from one area to another. For example, look at the reporting in Switzerland. Various people mentioned demand-side risk and strategy risks, and thinking about how to include information that is in captives in some meaningful way. And this is something that I've thought about in Solvency II, the Solvency II context, where there's a big emphasis on firms understanding their risk profile, making sure that their regulatory capital calculation matches their risk profile. But I've not seen very much on how a risk profile can be expressed and how that expression of a risk profile can be useful in running a company and understanding risks. And this is possibly another area that we could give some insight. Louise added to this by mentioning that any expression of a risk profile and how you measure and manage your risks has to be done without losing your competitive advantage. My personal opinion is I think disclosure is always useful, and it's always more frightening before you disclose things, but once you've disclosed things, you actually find out it's not as bad as you thought. The third challenge is about expressing a view on the effectiveness of risk reporting. Didn't have many comments on this, but we now have the indices that are in the paper, so we have some statistics where we can measure the quality of this reporting. It's a good starting point, and it's a really practical one. And I think Paul made a good point when he mentioned the difference between rules and practice. So you can think that you've got a regime that is working really well because you can point to your rules, but actually in the observance of those rules, it's not working. And again, the actual profession, if we had these measures, we could give an opinion about this. The final challenge was whether we should be developing and supporting papers on risk reporting. Should we be accepting this challenge as thought leaders on enterprise risk management, or should we be passing it over to the accountants to deal with? Paul pointed out that we could look at different perspectives, shareholders, regulators, internal perspectives, and Louise reiterated this. And there is a big lack of clarity on the different frameworks. Several speakers spoke about this. It needs something there to possibly cut through the lack of clarity. There is a debate about whether this is more or less important for insurers. It's a good challenge about whether insurers are good at managing risks, or whether insurers should be looking at risks external to the company as well as the insurance risks that they face. And we could also think about the actuarial profession's role in other industries. Going back to the presidential address for this year about ramping up our relevance, maybe we should be using our skills in other industries, using what we've learned from insurance, and making some recommendations about risk reporting there. Possibly there is some work we can do about making position statements on the usefulness and practicalities of stress testing. This is something that Chris O'Brien mentioned. So to me, this is still an open question. So I think the 4 questions, the 4 challenges are good ones, and we've had an interesting and useful debate about them, but I think there is more to say on all of these. One twist that I think is important is that you can report lots of clear, meaningful information, but if no one reads it, it counts for nothing. Over the last year, I applied for a role with Network Rail as a volunteer job, not leaving the regulator. And I did a lot of research on the information that was publicly available about Network Rail. And it's amazing just how much there is. Now, part of me thinks that as we live in a democracy, we have a responsibility to go out and read this information. But I've probably spent about 3 days of my life researching every aspect of Network Rail, their strategic plan, and the governance arrangements around the organisation. So that's just one of the organisations in this country. It was a lot of work, a lot of research. I feel better informed. I feel happier when I'm travelling on the train now. And I feel like a responsible citizen. But it's a lot to ask of people to understand this information. So it's not just a case of getting information out there. It has to be easily accessible, relevant, and easy to understand. I did feel that there were some good points about the motivation for reporting, that the motivation of the people reporting can be different of the motivation of the people reading, and incentives need to be aligned if reporting is going to be useful. I thought John Instance's point about the users of insurance possibly not using, the users of insurance accounting, or potential users not always using the information or understanding insurance accounts was a good one, and goes back to my point about Network Rail information. David Martin made the point that we should be training people, in possibly building on our SERA qualification to improve risk reporting and make sure more people understand it. I do think that we should be building on our SERA qualification. We shouldn't just leave it where it is and rest on our laurels. It should be something that does develop. So this is another area to look into. And I was intrigued that Paul referred a lot to conversations during his presentation, which highlighted for me that reporting is the starting point. Once you have the information, you have to talk about the content of it. So maybe that's something else we should be doing, not just training people on what to report, but then how to have conversations about the content of it. And finally, one thing I love about my job is that I'm still learning, and I think it's great that our profession is constantly finding new areas where we can apply our skills. Risk reporting is definitely one, and we should build on this paper and take seriously our SERA credentials and fill this gap.
Thank you very much indeed, Catherine. So just, I guess, with a few minutes now, Paul, in case you want to have any final comments that you want to wrap up. And I know there's the initiative of the Australian Institute of Actuaries as well on risk reporting, and a meeting as well at the end of October to take this work forward. So if you want to sort of mention those and talk to those, that'd be great. Thank you.
Thank you very much. Well, I would like to take this opportunity to thank everybody for coming today and giving your views, and whether it's technical or whether it's more kind of global general comments, were very much appreciated. I'd like to also very much thank a number of other people as well. Elliot has been very much a guiding hand with a lot of this, and I'd like to thank Elliot very much for his kind of leadership here. I'd like to also thank Tracy Zalk, who's very much helped our working party get to the level of where we are today. So we're very grateful to you, Tracy, for coming along today and helping out. I'd like to also thank the speakers who came today. I'd like to also especially thank Catherine for her very helpful comments at the end. I will mention a few things. I'd like to also thank the other speakers who came as well, particularly the regulators and also Chris O'Brien and others who gave different perspectives. Let me close by saying a few comments in response to Elliot's. I suppose incentives are important, and I think one of the kind of the fairy tales going back to a novel, I'm actually reading Dan Brown's Inferno at the moment. It does worry me that there's some demographic researcher or actuary who's going to destroy all the good people because he knows that the world is not going to survive due to population explosion. So sometimes the risks are just so bad, we just don't want to talk about it. And I think it is important to, when we're having a conversation about risk reporting, to delineate, the good stuff and the bad stuff, and to what extent risks are things that we identify as being part of our environment, or which risks are risks that we can and should manage as part of our work environment. So I think reliability of the information is very important, and that's where actuaries have a role. There's also a trade-off between the reliability and precision of that information and its relevance to the users, and so it does concern me that we need to have more discussion about disclosure effectiveness and whether these communications are actually getting across to the stakeholder or to the senior manager. The other kind of comment I would like to make, I would like to draw people's attention to the importance of disclosure about risks. In the banking community, that's often done through things like Pillar 3 and through the risk-weighted assets conversation that seeps through to capital ratios. We haven't yet seen that level of transference happening in the insurance context, so I'm very much hoping that with the Solvency II issues, once they do get clarified, that we can actually have more of a transparent discussion at that point. I would like to also finally mention, just picking up on Elliot's comments, there are these two kind of initiatives happening. One is that in terms of cultural issues, obviously we talked about these three different hats, right? Regulatory, management, and kind of shareholder. What would be interesting is in environments where these three hats are kind of integrating more, does that lead to more effective risk reward for the stakeholders and for the managers? And that's why Australia is interesting in the context, in the sense they've kind of already implemented Solvency II, not just in insurance but also in pension and banking as well. So we are hoping to have conversations and perhaps develop joint work with our Australian colleagues to see whether there are some interesting cultural differences between Europe and Australia there. And Elliot has mentioned that as part of the contribution to the Enterprise Risk Management Thought and Development Leadership Group that he's leading, that this idea of perhaps getting a little bit more precision and documenting down what are the more specific takeaways to the profession that can come out of this topic rather than just a talk fest. Are there any specific guidance that we can actually come up with? So I'm looking forward to that. And I'd like to end my presentation and thank everybody for coming and giving us the opportunity to have this session.
Thank you very much indeed, Paul. Again. So with that, I'd just like to join me in thanking Paul, Tracy and the rest of the team for producing this paper and for the discussion.